Well, hi, everybody. A very warm welcome to this joint Planet Tracker Changing Markets Foundation webinar, looking at the very important issue of agri-methane. And the particular focus today is to look at the financial institutions funding a very heavy climate footprint in terms of methane through the meat and dairy industry companies that Changing Markets and the IATP covered in a previous report called Emissions Impossible. I'm delighted that we've got a number of other organisations joining us on this webinar. We've got somebody from Upfield, somebody from FAIR, and somebody from Danone as well. I'll introduce all our panellists in a moment. Just in terms of sort of housekeeping, we will be having a discussion the second half of the webinar. So if you want to submit questions, if anything comes to mind as the presentations are going on, or once we get into the discussion, please use the Q&A facility. Don't use the main chat. Pop your question in the Q&A, and that way we can answer it, hopefully during the webinar. But obviously, if we run out of time, or if it's a bit more sort of technical and we want to take it offline, then one or other of the panelists can get back to you after the webinar. And it will be recorded, and so you will be able to review it again up on the Planet Tracker YouTube channel and various other places as well. So we'll send details around after the webinar. But without further ado, let me introduce our panelists. The webinar is obviously in relation to the report that we issued on Tuesday called Hot Money, looking at 40 financial institutions funding a climate-changing agri-methane footprint. And I'm delighted that I've got a number of people here to join me in discussing this issue. Welcome to Nusha Urbanchik, the Campaigns Director at Changing Markets Foundation, and they co-wrote this report with us and sponsored the research, and it obviously builds on the back of other research they've been doing, which Nusha will be talking you through in a moment or two. We've got Sally Smith, who's the Global Director of Sustainability and ESG at Upfield, which, as far as we're aware, is the first company to actually publish methane targets and really begin to take sort of a leadership role in terms of methane emissions. So we're delighted to have her on the panel. We've also got Tara Chandrasekaran, who is from FAIR, the investor network, and they've been doing work on methane, among other agricultural issues, for a number of years. So she will also be contributing to the discussion. And then last but not least, big welcome to Jeanette Coombs-Leno, who is the Global Sustainability Advocacy and B Corp Director at Danone. And Danone on Tuesday, fortuitously at the same time as we issued our report, they also issued methane emissions reduction targets, and one of the first of really large food and dairy companies to actually do that. So we're delighted to have you with us as well, Jeanette, and she's going to talk about some of the sort of challenges around actually measuring methane emissions and setting credible targets. But before we get on to all of that, I'd like to hand over to Nusha, and she is going to talk us through some of the work that Changing Markets and the IATP have been doing preceding our report. Nusha, over to you.
Yeah, thank you so much, Peter, for this. As you said, I will be presenting our report, Emissions Impossible Methane Edition, that we launched last November during COP27 together with IATP. But before going to that, just to set the scene, why methane is important, just briefly dive into the science of methane. As you can see here, methane is 80 times more potent than CO2 over 20 years, but it's short-lived, so it disappears, not totally, but start to dissipate after a decade. Concentrations of methane in the atmosphere have also been increasing. Just last year, WMO said that we have seen the biggest year-on-year jump in methane concentrations from 2020 to 2021 since the measurements began 40 years ago. And this is very concerning. Agriculture is the biggest source of methane. Globally, it's responsible for 40%, and 32% of that approximately comes from animal agriculture. If you look at specific regions, in the EU, it's 53% is livestock, and in the US, it's around 36%. And it has increased in the US by 20% since 1990. So it's not slowing down. And this is also what current projections are telling us. Under the policy as usual scenario, we see 30% growth of methane by 2050. But scientists have told us in 2021 that we can achieve 40 to 45% reductions by 2030 in a cost-effective manner. And when methane kind of came on the agenda, this kind of like a lot of this we can thank to the Global Methane Assessment by the UN, but also the more recent IPCC reports. What they have been telling us is that reducing methane is a key strategy in slowing down warming. It could allow us to stay below 1.5 degree temperature increase and avoid reaching these irreversible tipping points. Cutting methane is so significant that scientists have been calling it as an emergency brake and also as one of the most significant climate actions the world can take in this decade. Then on the back of that, we got the Global Methane Pledge at COP26 in Glasgow, where world leaders have committed to 30% reduction. This pledge was spearheaded by the US and EU. And as we can see, it's at the lower end of what the science says is necessary. And it's also a collective target. So it's unclear yet how it will be divided amongst the signatories. But currently we have 150 countries that have signed up to this pledge and are kind of developing mitigation plans. I want to kind of highlight that on agriculture, the pledge is weaker than on waste and energy, where the signatories are asked to make all feasible reductions. But yeah, as seen before, agriculture is a significant source of methane. And also we tried to highlight through our research, through our first report, Blind Spot, but then also through this Emissions Impossible, that actually methane from livestock is quite concentrated in the supply chains of a few global meat and dairy companies. 11% of methane, according to our estimates, could be attributed just to these 15 companies. And this is significant. And on the other hand, we also have CO2 emissions, which also have to be reduced. Like science is very clear that we need to reduce CO2 emissions from meat and dairy if we want to stay on 1.5 degree pathway, even on 2 degree pathway. And here you can see basically how these 15 meat and dairy companies compare to the emissions of countries. So they would be the 10th biggest emitter if they were a country, and also individual companies. So you can see JBS is kind of even above some of the oil companies that we hear a lot about. Focusing on methane again, we can see this is just enteric fermentation and manure management calculated over 100 years. And we can see that methane emissions of these 15 companies are 52% higher than livestock-related methane emissions of the EU and 47% higher than those of the US. And looking at individual companies, JBS is the biggest methane emitter, which has similar emissions to combined emissions of France, Germany, Canada, and New Zealand. Marfrig has the second biggest emitter, has methane emissions similar to Australia's entire livestock sector. Fonterra compares to Ireland. Arla and Danish Crown have 1.5 times higher total methane emissions than their home country, which is Denmark. And then Nestle has twice the methane emissions of Switzerland, livestock methane of Switzerland. This becomes even more significant if you look at methane over 20 years. You can see in this graph how much it increases. And also it's very kind of, if you look at it as a percentage of emissions for specific companies, you can see that it ranges anywhere between 50 to 80% with companies that do milk or beef, and 25 to 50% with pork companies. Why is this important? It's because UN last year kind of said if gas is material to your company, to the performance, that greenhouse gas contribution, then you have to report it separately and also have a separate methane action plan. At the time of writing this report, none of the companies that we looked at actually reported methane emissions. And only 60% of companies did not report their full scope 3 emissions. Some of them nothing, some of them just partial scope 3, as you can see here. I'm very glad to say that this has changed this week with the Danon's announcement, which we'll hear about later. But yeah, our kind of conclusion making all this research is that we do need government regulations. I don't have time to go in detail into our recommendations, but you can look at the report. But I think it's really key that we have binding greenhouse gas and methane reduction targets for the agricultural sector. And those targets should be in line with temperature trajectory to 1.5 degrees. And we also need consistent reporting. We need scope 3 emissions to be included. And that's also becoming a legal risk for companies now. We've seen that Mighty Earth put in a complaint to SEC yesterday because JBS did not report their scope 3 emissions. And we also need a system of independent third-party verification. I think major producing countries must take the lead. So here you can see countries where these companies have headquarters, and over the last decade, none of them had a significant reduction of methane emissions. Some emissions went up, and most of these countries have actually signed the methane pledge, with the exception of China. But China is also working on their own methane plan. So I'll just park this here and hand over to Peter, who will present what the financial sector is doing with regards to methane emissions.
Fantastic. Thank you, Nusha. Really, a really interesting report. Definitely recommend downloading it and having a look. So wanted to just move on and show the work that we did on the back of the Changing Markets IATP report to look at the funders standing behind these 15 companies. And it's an extraordinary statistic that sort of 11% of the methane emissions coming from these 15 companies based on IATP Changing Market Foundation's estimates. And the other point, again, big congratulations to Danone for sort of coming out with the data, but so many of these companies are not really giving us the information to make the right estimates and therefore make the right decisions. And so it's only fair to say that our research is based on estimations produced by Changing Markets and by the IATP, and then by our own work as well. And that's because we've often had to fill in the gaps where companies haven't been providing us with the information. So what we looked at in our research was we looked at the top 40 financial institutions, 20 equity investors and 20 banks standing behind the 15 meat and dairy companies that Nusha's just been talking about. No great surprise, really. I think whenever we run these lists, particularly of equity investors, you always find that the sort of the really large asset managers around the world, BlackRock, Vanguard, State Street, big passive asset managers who have large sort of stocks of ETFs, they naturally come quite high up the shareholder lists of any company you're looking at, to be honest. Now, that means on the one hand, they're at the top of the list. It's not necessarily a reflection of the fact that they're sort of particularly good or bad in this context, but I think it does just re-emphasize their power and their position of influence. And particularly for investors who are passive, we're very keen to see them really engage and use their shareholder power and their votes to actually influence the direction of companies, and particularly in the context of agri-methane. One of the things that we did spot, which I think is quite interesting, and on this particular chart, they're labeled with a rather small O to the right-hand side, there are a number of organizations where if you ranked them simply based on their sort of size, which would normally tell you roughly where you'd expect them to appear on any list of shareholders in any company, we'd expect these companies to come lower down the list. So the fact that Capital Group, for example, Sun Life Financial, UBS, and Credit Suisse, just to pick a few towards the top of the table, the fact that they are right at the top of the table suggests that they are holding higher levels of meat and dairy companies in their portfolios than you might expect if they were simply sort of tracking an index. So in other words, there would appear to be an active decision to invest in those companies, presumably because they think that they will generate great investment returns for their clients, which is, of course, their job. But it also means that they are effectively buying into and sort of supporting this extensive methane footprint that we're talking about. When we look at the banks, here I think it's a little bit more interesting because there is no specific reason why a particular bank should come top of the list. Clearly, some of these banks are naturally very, very large, but this is quite a sort of specialized area. So you could expect, a range of banks to come at the top. Here we can see JP Morgan leading by a very, very large margin. And you can also see, particularly interesting point, that Morgan Stanley, which comes second, their lending relationships are entirely with the meat sector. We didn't detect any sort of strong relationships with companies in the dairy sector at all. So there's a very strong sort of meat bias. And then you've got a number of the French banks coming in there as well, obviously, because they are much more likely to have relationships with companies like Danone and Lactalis and the like, because of that sort of big presence in the French market of the dairy industry. And you can see the geographic split on the right-hand side, so absolutely dominated by the US and French banks, with banks from other countries coming sort of very distant, sort of third and fourth. And a lot of these banks do have relationships, again, as you would expect, with sort of the big companies. So it's no surprise that every bank in the world wants to have a relationship with Nestle. They want to have a relationship with Danone. So they're all trying to, and a great many of them have succeeded. Whereas when you look at companies like JBS, for example, there's a slightly less sort of competition to get onto the lending sort of syndicate list. Now, what we did was we decided that we would try and attribute a methane footprint to the financial institutions. Now, there are various different ways you could do this. Because we were looking at it from a sort of a financial institutions funding perspective, we thought that using the capital base of each company as the sort of the dividing factor would be one way of doing it and would be sensible in our context. So we took the methane footprint that Nusha's just been talking about, and that's on the 20-year basis, so the sort of the higher number, because we're looking at this sort of 20-year time frame to get everything sorted rather than allowing companies 100 years. So we're using the GWP 20 methane footprint, and we're dividing it by the company's capital, and that gives us a methane to capital ratio. And we can express that in kilos to dollars, and then we can use that ratio and apply it to the actual dollar value of the funding that's being provided by the institution to get a methane footprint for a particular financial institution. Now, the other thing that's interesting from this chart, you can see that JBS has a very big methane footprint per dollar of capital. So once you start to scale their methane output against the size of the business, you see they really have a very, very heavy footprint. Whereas down at the bottom, companies like Danone or Nestle, much bigger, much more diversified organizations, and therefore their methane footprint in the context of the overall size of the company is actually sort of a little bit smaller than it is for more concentrated businesses like JBS and Marfrig. So applying that methane methodology, this is what the equity investors look like. And now you can see you get much more diversification between the investors. So Vanguard holding very large stakes, but also holding large stakes in the companies with a large methane footprint. So you're getting that sort of double bias coming in. Whereas down towards the bottom end of the scale, companies like Wellington and Pictet and Schroders, they have smaller stakes anyway, but also their bias is more towards the dairy end of the spectrum, and therefore their methane footprint is much smaller. Now, when you add up all of these equity investors, the top 20, again, going back to the sort of comparisons Nusha was showing you, you end up with a methane footprint converted into CO2 equivalent units that then looks similar size to Austria's CO2 footprint. So this is a very large number, 68 megatons of CO2 equivalent units. When we look at the banks, we get a much bigger score because their exposure to these companies is actually much larger than the equity providers. 200 megatons, that's 3 times the equity investor sort of size. That's the same as Spain in terms of CO2 footprint. And this time, notice the leaderboard at the top has switched because Morgan Stanley has very big exposure to the companies, but as you'll remember, it's all meat, and therefore it's effectively supporting a much bigger methane footprint even than JP Morgan, in spite of JP Morgan's heavy lending to the sector, because JP Morgan's a little bit more diversified over meat and dairy. But some really quite large sort of statistics coming through that exercise. Now, the other thing we did, looking at banking relationships is quite hard because the disclosures are very poor. A lot of banking relationships are obviously private, confidential, which is sort of one-on-one or one on a few. So it can be difficult to assess exactly how much these banks are really acting in support of the sector. So we looked at this in another way, and we basically said, if we can identify you as having been a member of a banking syndicate, we're not going to worry about what appears to be the amount that you've lent. We'll just say you're in a relationship with this company and we're effectively going to attribute the methane footprint based purely on your relationship rather than trying to be clever around exactly how much money you've lent, because frankly, it's quite difficult to tell whether that precise number is right or not. Again, JP Morgan on this basis now comes top of the leaderboard just because they've got so many relationships right across the piece. And then you start to see a number of the Brazilian banks coming in because they've got relationships right across the meat sector. So not necessarily counting the fact they're lending you perhaps slightly less, but simply saying you are absolutely integral to the funding of these companies. And part of the logic behind this is if you're creating a syndicate of banks to finance a company, if you can't get a key bank like Banco BDG Pactual, for example, to join as a local bank saying, yes, we support this company, then you may actually find international banks wouldn't actually come into the syndicate at all. So having all of these banks in the syndicate is potentially crucial, and therefore it seems a reasonable way of holding them responsible for the methane footprints that they are supporting. We then looked at their policies to see the extent to which the banks and the institutions were actually thinking about methane and specifically agri-methane. And this is where things got really very disappointing. We used a simplistic sort of scoring method that gave a maximum score of 150. We were looking at three main policy areas: financing sustainable agriculture and or land use. Do they have any sort of ambitions in that area? Do they seek to control or monitor methane emissions from funded companies? And do they look at the GHG emissions more broadly from funded companies? And broadly speaking, they're scoring very badly on all three of these, and particularly in relation to methane. Only 23% have a policy that specifically covers methane emissions in general, and none of them have a policy that looks at agri-methane. So that is a major disappointment, I think, at the moment, and a big gap as far as financial institutions are concerned. Now, the good news, if you like, is that if they take steps on methane, as Nusha was eloquently setting out, methane is a very, very high sort of high heating gas, but it depreciates in the atmosphere very quickly. So if we actually cut emissions of methane, we will have a very amplified beneficial effect on climate change, and that could be very important from a net zero perspective, from an asset manager's or a bank's perspective. And so finally, what do we think these financial institutions should be doing? Well, very simply, they should be putting policies in place. We don't think any of them have got any policies around agri-methane, so that would be a very obvious step one: get a policy. What should the policy look like? Well, it should actually be requiring specific limits on methane emissions, which are quantified, independently verified, and particularly take into account scope 3, as well as the methane emissions coming strictly from the operations of the organisation itself. So that would be the key thing that we would like to see them address. And I think the other thing, just to bring this back to the Global Methane Pledge and all the countries that have signed up, all of these banks, bar the Chinese ones, are situated in countries that have signed the Global Methane Pledge. So their governments and their regulators believe that methane is a really key issue. We expect these financial institutions to follow suit. I will stop presenting at that point and throw it open to our panelists. So let's do that. Now, we've had a number of sort of points being raised in the presentations that Nusha and I have been giving. What I'd like to do first, Tara, if I can turn this over to you. Your organisation, FAIR, has been looking at methane as an issue for a number of years, and I just wondered, whether you could give us your thoughts on how these two reports, particularly ours looking at financial institutions, how do they resonate with what FAIR is trying to achieve, and what do you think of Danone's announcement as well?
Yeah, thank you, Peter, and thank you for both of your presentations. So I think what really stood out from the report for me, as you had highlighted as well, was the influence and power that these financial institutions can have on companies through their engagement and dialogues with these companies. And in particular, the section in the report on the investor call to action, I felt really reflected the areas of concern that we have identified in our analysis at FAIR of 60 of the largest listed protein producing companies, including companies like JBS, Tyson, WH Group, the companies that you have looked at as well. So what we highlighted in our research is that investors need better and more information from these companies in order to inform their own decision making. And as I said, we identified similar areas of concern that investors need to focus on when speaking to these companies. So over 80% of the companies that we look at don't disclose their methane emissions at all, don't disaggregate by gas, which is particularly concerning because investors need to understand their exposure to this gas, which is useful, Nusa, through the estimations provided in your report. And another key factor is we really want these companies to be setting time-bound, science-based emissions reduction targets. And again, over 80% of the companies that we look at don't have these targets yet. We're seeing more of these companies committing to targets, but still we would want to see more movement here. What's promising is we are seeing more companies disclose innovation focused on methane and emissions from animal farming. So we're seeing quite a few companies talk about methane reducing additives, things like methane vaccines, wearable devices to mitigate emissions from methane, but we're not seeing any of these at scale just yet. And another key point is we need to understand the mitigation potential of these innovations, because there's a lot of science out there, but it's not clear what the actual impact of these innovations are. But it is encouraging to see that investors are engaging with these companies on these topics. So at FAIR, for example, we had an engagement focused on climate and water with 6 of the largest quick service restaurants, including McDonald's, Wendy's, Chipotle. And that was focused, as I said, at climate. And we were encouraging companies to really set science-based targets. So now all of those 6 companies have either committed to or have already set science-based targets. And we also recently launched an engagement with 10 companies focused on waste and pollution. So looking at livestock waste and the biodiversity and climate impacts there. So that focuses on companies including Tyson, JBS, WH Group. And with that, we have around 23 trillion in asset under management behind the investors who have signed on to that engagement. So that's really encouraging to see that investor pressure and interest in this space. So it's really great to see Danone really leading the sector with the target that they have just set, the fact that it covers their whole milk supply chain, especially since methane is such a large part of Danone's total emissions. So we would really encourage other companies to follow suit. And as I said, it would be useful for investors to be able to see alongside this target what the specific practices are to achieve that mitigation and what the potential of each of those practices and actions are to be able to get to that reduction goal.
That's really great. Thanks, Tara. And you mentioned wearable devices, which brings all sorts of strange images to mind. But we unfortunately don't have time to explore all the details of that. But yeah, go on the FAIR website, get in touch with FAIR if you want to find out more on what they're doing on that methane issue, and that engagement from investors, I think, is really positive. But in terms of companies, so we've had a degree of rather sort of critical comment, but we've also got 2 companies who are definitely leading the charge in terms of disclosure. Jeanette, I wanted to turn over to you first, really, because your news is the newest, rather than perhaps being the most first off the block. But can you tell us a little bit more about Danone's sort of approach and specifically, what are the things that you found challenging around methane, and why have you now decided to announce these targets?
Yeah, thank you so much, Peter. It's really great to be here, especially this week. Well, you've mentioned it. We set a methane target that's aligned with the Global Methane Pledge for our full fresh milk supply. which is 70% of our methane footprint. For the other 30%, which is linked to our dairy ingredients that we don't source directly, but through suppliers, we are going to engage them. And so this is also part of our strategy. This was something that we've been constructing for over a year now. And I think I can say it's really the fruit of a lot of different discussions, including many discussions with changing markets. So I think what you're doing is really important, just to highlight the importance and the opportunity that companies have to step up and show leadership. Maybe just a word about how we will go about tackling the challenge. So we've already been tackling methane. It's really kind of inherent in our regenerative agriculture program. We have 25 projects in 14 different countries. So we've seen how to do this. What we didn't do before is really get explicit and very focused on the methane reduction piece. And so with all this kind of momentum we've done a lot of self-education and been educated on the importance of this, and seeing really how important methane is right now and the opportunity is. So we really kind of saw the need to kind of focus more explicitly in our program on this piece of it. So broadly speaking, we kind of say that we will work across farming models, because we work with all different types of farms across the world, but we'll work across farming models to adapt solutions that are, of course, relevant for the context, but that broadly speaking are around herd and feed management first, because we're looking for ways to optimize production per cow, and also in general that's just also optimizing the health and well-being of the animal. The second bucket being manure management, with a lot of different solutions that we've tested, and we're going to be going further with that. And then the last bucket being what you mentioned before, these innovative solutions. We have piloted a feed additive in Belgium called Bovaer, which is kind of known, and saw promising results that we published in a journal. It was over 18% reduction. There have been other studies that show higher potential. We're also investing in some startups, including the accessories, a startup called Zelp that's working on the accessories, and then another startup that's also working on the additive piece. Knowing that kind of for us, this is really part of a holistic approach. So we wouldn't want to be in a situation where we're only focusing on the innovation piece, because it's important to get the fundamentals in line. And so that's something that we're looking at as kind of a way to go the last mile. Maybe just another word about why we've done this, beyond the obvious that this is a really important topic and opportunity. So what we realized, we recently set our science-based target, or flag target, and what we saw on that was that indeed this focus on methane reduction was going to be absolutely critical to achieving it. And so we have the flag target, but we thought it's actually important. It's so important, and actually, that we need to be explicit and be public about the role that methane plays, and also measure separately our methane emissions and report separately on our progress. So that is going to be part of our commitment. And then maybe one more piece of it, I think obviously this is a really collective kind of work. And so we announced also a partnership with Environmental Defense Fund, which, like Changing Markets and like yourselves, have been really active on this topic, and they're going to be working with us on the reporting aspect, which we mentioned. That is challenging. It's a kind of a continuous progress, and I think we need to go further. They're also going to work with us on something we feel is really important, another challenge, which is really getting the economic models in place. The last thing we would want to do is do this to the detriment of farmer livelihoods. So getting the models in place that show these can be a win, not only from a planet perspective, but also from a farmer livelihoods perspective and profitability perspective, is really important. So they're going to be working with us on the economic analysis piece of it, and kind of the different models and co-financing models. And then the last piece of it is really kind of mobilizing more broadly the industry and all the different stakeholders that can play a role in this. And it's just great to see FAIR being. I know they've been really active on this, and clearly the finance sector has a key role to play in this, and other sectors too. We're very convinced that that policy, the Global Methane Pledge, that given the commitments governments have made, there is an opportunity for them to kind of focus more specifically on agri-methane. So the last piece of we're looking at is this kind of collective collaboration piece, which is really important. And that includes not only on the financing models and on the measurement, on kind of harmonizing standards, but also even on the innovation piece, because Tyra, as you rightly pointed out, these innovative solutions are really promising, but they really need to be tested and understood, at a deeper level. So that's something that we see a need for kind of broad collaboration, including with finance and also public sector. So really, we're really excited. We know it's a journey, but we're excited, and we're hoping that others in the industry will also take this step. And that, if they don't set a 30% target that's aligned with the Global Methane Pledge, that they also report separately on methane emissions, because that's just a great way to start. And we will do that. We are looking at the different kind of ways to calculate GHG emissions and methane, and we know it's a complex topic. So that's also where this kind of the harmonization on standards could play a key role. So I'll stop there.
Fantastic. That's an amazingly concise and detailed summary. Thank you, Jeanette. That's really interesting. And I think this idea of collaboration is something, it's a theme that comes up in a lot of the conversations we're having, that, the work that you guys are doing, the work that Upfield is doing, it's not just about you, it's about your supply chain. You were mentioning farmers, that it needs to be a win-win. And obviously there are a number of organizations in your supply chain that will be key to this effort. And we've also heard from other people that sort of collaborating with peers, so potential competitors, which obviously creates some issues in terms of antitrust regulation and those sorts of things. But within the right framework, that too can be very important. So hugely encouraging. I think when a large organization like yours actually puts a number on a target, you can be quite satisfied that the C-suite has looked very carefully at it, because they don't like to miss these things. So a reasonable high confidence that you'll meet it, but good luck with that. Sally, I wanted to turn to you. Upfield, obviously, a little earlier out of the traps than the large organisation of Danone. What motivated you as a smaller company to take on what some people might regard as a large burden and start doing methane reporting and target setting? Can you tell us a bit about what you guys have been doing?
Yeah, absolutely. Thank you, Peter. So for those of you who don't know, Upfield, we're the world's biggest plant-based food company, and we have brands like Violife Cheese, like Flora if you're in the UK, or Country Crock in the US, and plant-based creams as well. Again, your UK brand would be a brand like Elmley or Rama in Germany. So to give a flavour of some of the brands that we own in the portfolio. But we started looking at this actually on the back of the last COP, and it became really clear and apparent that there was a gap in the agri sector. So fantastic commitments coming out under the Global Methane Pledge. We recognised the gap for agri. We also recognise the gap between the 30% commitment that's been made under the Methane Pledge and the 45% guidance that's come out at a global level. So we recognise that even the pledges that are out there are not sufficient. And so methane and urgent action on methane is going to be absolutely critical. And so we questioned, well, what can we do as a company? And we just didn't understand our own methane exposure at that time. We didn't know whether what part of our global greenhouse gas footprint was methane or wasn't. And at the time, we were reporting our scope 1, 2, and 3 emissions and following robust practice. But we asked that very first question, well, what's our methane exposure? What is it that we can do? And so when we ran the numbers, we sort of launched into a piece of work thinking it was going to take a long time and be very complex, and we were going to get wrapped up with a lot of scientific debate. But actually what became apparent very quickly was, if you're running a greenhouse gas inventory with scope 1, 2, and 3 emissions, your consultants can pretty rapidly pull out the key component parts of that footprint. So what we thought might take months actually only took a couple of weeks, and somebody could pop out and say, well, of your footprint, here's your methane exposure. And that led to some really fantastic insights. So what did we learn? We learned that whilst within our portfolio, actually we have a very, very small amount of dairy left in the portfolio, around 1% of our total global ingredients by weight of dairy. It actually accounts for a disproportionate part of our global greenhouse gas footprint, so around 8%. But over 60% of our methane comes from that one ingredient that's only 1% of our footprint. So at that point, you start asking the obvious questions about, well, what can we do? And the urgency of action here means there are, yes, clearly huge opportunities for both the meat and dairy industry to reduce impact, to improve practice. And it's fantastic to hear the scale and ambition of the work that Danone are now leading in that space. And kudos to Jeanette and the team for the work that you're doing on that. But in order to get beyond the 30%, there are untapped opportunities, particularly in how we can shift dietary patterns. So where we have an absolute target that we need to achieve, we've got to be able to think about how we reduce the consumption of meat and dairy in line with guidance that's coming out. So with a portfolio of plant-based products, we're really curious about, well, how do we shift our products to fully 100% plant-based? So we have a target to eliminate dairy by 2025, and that will, by virtue of doing that, deliver over 60% methane reduction in half the time. So if we're thinking about that 45% target that we're being asked to really stretch towards if we're going to tackle methane now, I think it's really important to think about not just improved practices, but some of those shifts that we can make to more sustainable, healthy diets that are going to deliver on multiple benefits, not just for the climate, but for nature and for human health. There's big challenges out there. So we're really excited to have kind of asked some challenging questions of ourselves nearly a year ago now. We're coming up for our next report and are looking at a second year of disclosure and reporting. We've provided some guidance on our website as to how you can go about doing that, and are really keen to support others in looking at what's possible and really considering that question about what is our footprint and what can we do about it.
That's fantastic. Thank you, Sally. Very, very encouraging to hear. But also extraordinary, that sort of point. You mentioned 60% of your methane coming from sort of 1% of your production footprint, which just shows, the challenge, but also the opportunity, because if you can find ways of actually addressing what is a relatively small part of the business, you make a massive difference. And we've had a lot of questions, and I must apologize in advance. We've got 15 minutes to run. We're not going to get time to get through all of these questions. We'll do our best. There's a question from Anneke Borsma. Sorry if I've pronounced your name slightly incorrectly, Anneke. And Anneke is saying the most efficient way to reduce methane is to reduce the production of livestock, which was sort of the point that you were beginning to touch on, Sally. Tara, I know that this is something that FAIR has been sort of looking at. So maybe I could start with you. I mean, is it actually that simple? Is it just that we need to sort of stop eating meat, if you want to put it in sort of Sun headline terms, or is it actually a good deal more nuanced than that?
I think it's quite a complicated answer, but it definitely varies significantly by region. I know in sort of more developed markets, we are seeing the consumption of meat move towards its peak, or perhaps it's peaked already. So I know, for example, in New Zealand, Fonterra's, some of the leadership in Fonterra have talked about milk peaking in that region of the world. But when it comes to more developing regions like China and India, we are seeing the consumption of meat continue to grow as incomes increase as well. But I think an important thing that is being discussed in the sector, in the financial sector among our investors, is definitely a substitution towards more alternative sources of protein. So we have definitely seen growth in the companies that we look at. So as I mentioned, we assess 60 of the largest protein producers. And since 2019, we've seen significant growth. So in 2019, there was only around 20% of companies that had any exposure to alternative protein. And now it's around half of the companies have some exposure. So we're definitely seeing growth there. And that's quite a promising solution in addressing those high methane emissions.
Jeanette, I didn't know whether you wanted to jump on that one as well. Obviously, Danone, not sort of a particularly meat-based company, but dairy has its own pretty heavy footprint.
Yeah. So maybe just to say that, we're a dairy leader, but we're also a plant-based leader. So we are a leader in both categories, and we don't like to think of them as opposed. We like to think of them, as together. And in fact, what we see, from a lot of consumer data is consumers are really consuming, both, which is fantastic. Maybe just what we like to remember is that when you're talking about something like dairy, you're talking about something that is not just a question of nutrition or alternative proteins, even if there is a nutritional lots of nutritional benefits associated with it. But you're talking about something that also has a very important economic and also cultural footprint. So like over 1 billion livelihoods estimated depend on the dairy industry. So just something to keep in mind when we talk about this. But in general, we don't like to oppose them. We're a leader in both.
That sounds good, and I think that's an interesting point. And I think we hear a lot of chat about sort of flexitarianism, if you like, people eating sort of a variety of foods. And I mean, you touched on the point, Tara, about emerging economies, developing economies, where stereotypically, as they move up the income scale, there's actually then a shift towards dairy and indeed meat. And if we can sort of find ways of offering consumers and offering governments sort of alternatives at that stage that maybe are cheaper, but certainly are perhaps better for the planet and indeed taste better, then people will naturally sort of diversify their diets rather than sort of making that stereotypical shift from sort of much more veg to much more meat, which would be a very, very helpful thing. Wanted to move on to one of the other questions. Anna Ratcliffe asking, are there any regulations coming down the tracks which might help to get investors to address methane in investments? And Nusha, I didn't know whether you wanted to have a crack at that one.
I leave the investor part to you, but I did want to say that on the we do believe that the methane pledge will spur action, so that countries will have to come up with their national action plans. They'll have to make methane more part of their climate policies and really start thinking where the reductions will come from. And we also see that, in lots of, for example, in Europe, European Parliament already indicated that they want European Union to individually achieve at least 30% reduction. And our own studies show, we did some research, we commissioned at the CE Delft Environmental Consultancy in the Netherlands. And that research indicates that the best way to cut methane emissions in countries or constituencies like Europe is actually promoting healthier diets. That would mean around 50% reduction of meat, 25% reduction of dairy. And if 10% of Europeans did something like that, you would achieve 30% reductions, together with some technical measures, of course, on waste and energy. But if half of the population did something like that, you would do what science says is necessary, right? So this is the kind of conversation that we must start having. And again, it's about healthier diets. It's even about less protein, because let's face it, a lot of citizens in the global north overconsume protein, not just from animal origin, but in general. So I think this is really potentially an exciting win-win-win opportunity. And it's something that, we should kind of be pushing for in a light of, let's say, implementation of the Global Methane Pledge. And also, financial sector, I think it's also starting to look at nutrition from a more holistic perspective. So it's about like sugar, processed food. It's about reducing meat and dairy, I would say.
Yeah, I think that's a really good perspective, actually, to bring to bear. That it's very easy to sort of focus on meat is bad and everything else is good, but actually it's about healthy diets and sort of efficient and effective distribution of protein and calories to citizens right across the world, so that they actually end up with good food that promotes good health and long lives, rather than the current situation where we have some people with too little food and some people with too much, but often of the wrong sort, and the health outcomes are pretty negative. Tara, just in terms of that sort of financial regulation put you on the spot there in case you've got your regulatory hat on. I mean, I'm not aware of anything specific coming down the track for financial institutions, but I just wanted to check whether you'd seen anything that might have implications.
Nothing in particular I can think of targeting financial institutions on methane specifically, but I think what comes to mind in terms of regulations is sort of carbon prices, carbon taxes, the impacts of that on companies, which investors will then have to account for when assessing companies and looking at the profitability of these companies. So, for example, in New Zealand, we're seeing the introduction of a carbon price on agriculture, which will have huge implications for the large livestock sector in that region. So companies like Fonterra and investors who have holdings in Fonterra will have to sort of revise their analyses of these companies given those regulations.
Yeah, that New Zealand example is a really good one to raise, actually, and that's been something that's actually been sort of produced by the government in consultation with the farming industry and other parts of the food system. And as you say, looks as though it will have really quite a big impact. It's effectively sort of, the equivalent of a carbon price, but on the food system, which has in many areas previously been sort of exempted. And that might well be the sort of the straw that breaks the camel's back, or whatever the right analogy is. It will spark other countries to begin looking at it, because as the conversation's been going on in this webinar, and obviously in other places as well, tackling methane is a really sort of swift and important way of dealing with the sort of CO or the GHG footprint generally that companies, businesses, and indeed individuals have. So taking those sorts of steps is really necessary. And that, of course, goes back to the point you made earlier, Jeanette, about policy is going to be really key as far as this is concerned. One point, this is a little bit sort of stepping aside from the policy and the regulation debate. We've had a few questions coming up, and we'd wondered whether we could get away with not addressing the sort of the methane accounting issue. But several questions coming up, sort of saying, I'm curious about the comparisons between methane and CO2 footprints. What's the value of comparing the two? Should we be looking at them differently? Sally, maybe I can throw this over to you first, as somebody whose company's been looking at it. Nusha sort of illustrated the fact that you can look at methane on a 100-year basis, you can look at it on a 20-year basis. She and I were both talking about CO2 equivalent sort of units, converting methane to carbon dioxide, without spending the next sort of 5 hours giving a tutorial on methane accounting. Can you just sort of give us a quick pencil sketch on what are the sort of the key challenges?
Sure. And I think it is a very technical topic, and I'm by no means the expert. There are a whole suite of scientists who should quite rightly lead the discussions on the most appropriate way to account for things in certain circumstances. What we do as Upfield is take the lead of the international frameworks for accounting. So we follow GWP 100. It's about the lifespan of that greenhouse gas in the atmosphere. And we know that's a more conservative way of accounting for it. Probably a more relevant way in this context of urgent action to account for it would be GWP 20. But whether you look at one or the other, look at it in the context of your greenhouse gas emissions. So you've got to start by looking at your total scope 1, 2, and 3. And from in that understanding, where can you act first and fast? By looking at methane within that context, you might learn something new. You might see that there is a hotspot where urgent action can actually lead to a very different set of policies, interventions, thinking on your part as to what you deal with first, because it will disproportionately have an impact. So if you only look at greenhouse gas equivalents in their aggregate, so counting up all the different gases and whether one has an impact of 1 versus 80 for methane, so carbon versus methane has a much higher impact than carbon. If you only look at the aggregate, you might just miss that insight, right? So for me, you have to put it in the context of your total emissions. Like anything, you have to show full scope. It is quite complex, but do look at both and look at it in context would be my message.
Yeah, that's really helpful. And somebody's actually popped into the Q&A, the Sustainable Finance Disclosure Regulations will mandate financial institutions to disclose Scope 1 to 3 of financed emissions, presumably including methane. Well, yes, but not necessarily separately disclosed. And of course, where do financial institutions get their GHG numbers for their portfolios? They get them from the companies that they're investing in or that they're lending to. And as we've been discussing on this webinar, and as Tara was sort of, dramatically illustrating, a lot of companies are not really providing the details that their funders will actually require from their regulatory perspective. So maybe that will start to produce more pressure from financial institutions asking the question, saying, look, hey, irrespective of whether you think this is a good thing or a bad thing, we need this data for our own regulatory reporting purposes. So please supply it. So that could produce a little bit more pressure in that direction.
Peter, maybe I can just add to that, because I think for companies like listed companies and large companies in Europe, there's the CSDR requirements that will come in play into 2025, which start with that concept of double materiality, right? So if you have to look at your material impacts, you should in theory be identifying your climate impacts within that, whether it's under TCFD as an element of that. And so there is a vehicle, if companies have not disclosed split gas accounting within the context of their greenhouse gas disclosures under TCFD and CSDR, I think there's an opportunity for some questions in that space. I think it's a really important part of disclosure.
Yeah, thanks for mentioning that, Sally. I think that's some sort of regulations coming down the pipeline. 2025 might sound like a long way away, but certainly from a planning and reporting perspective, you need to start now. So
we're already getting started. So yeah, definitely.
Well done, Jeanette. Perhaps no surprise, given that you guys seem to be sort of out in front of a number of your peers. But that's good to hear. This presumably is going to be quite a heavy lift, isn't it? I think these sorts of things.
Absolutely, I think it's transformational.
Yeah.
Transformational and very helpful. I mean, I think to add to what other people are saying, I think, part of what policy can do, and, it's something that we have advocated for and we will advocate for, is, of course, set specific targets for agri-methane and report on those. But also, I think there's a really important kind of precedent they could set in just getting the industry by putting something out there, getting the industry to shift in this direction. So we're looking at policy very closely and seeing how we can help to bring the issue to the table. And sorry, I know I was thinking I wanted to add something else. So it's really about that level playing field, because we see time and time again, we know that we need to act on something that we start, but then we see this need at a certain point to kind of have systemic solutions and a level playing field. So we know that's we see that as absolutely essential on this, and that's where policy can come in.
That's a really good sort of point to make, I think. Policy shifting, particularly in the EU, and there's actually a question saying in the US the livestock industry is still heavily subsidized. I'm not sure it's just the US, to be honest. There have been a number of reports looking at subsidies in terms of the food system generally, and a lot of them actually, unfortunately, showing subsidies directed at what one might call sort of climate negative and nature negative practices rather than supporting the opposite. But the question asking, do you foresee policy shifting to subsidise more plant-based solutions? Sally, I don't know whether that's something you're hoping and praying for, but any thoughts on that?
We would love to see that, as I'm sure Jeanette would for part of her business. I mean, clearly that Jeanette talked a little bit about the level playing field. We would love to see a level playing field, whether it comes to taxes, incentives, subsidies. We know that certainly in some countries there isn't a level playing field currently, so at the very least we should get to parity. If we want to shift consumption behaviours and patterns, to Nish's point, address the 50% reduction in meat, 25% reduction in dairy consumption in order to keep in line with 1.5 degrees, particularly in high consuming countries. So let's be clear about the nuance. That's for high consuming countries, not necessarily for developing countries where there are nutritional deficits that meat and dairy will play an important role in. But for very high consuming countries, particularly in Europe and North America, we've got to find a way to use the environment that we've created through policy, there's an amazing opportunity to stitch something new that creates a set of consumption patterns and behaviours that will help in this space. There's a fantastic opportunity there.
That's a great sort of call to action. We're up against the clock, unfortunately, so I just wanted to give Tara and Nusha the opportunity if you have any sort of final thoughts before we have to close. And for those of you who have asked questions and haven't had an opportunity to have them answered, we will capture them all. We will do our best to answer them offline. Jeanette has said, please reach out to her on LinkedIn if you have a specific question for her. But Tara, can I just turn to you? Any final thoughts?
I think, on the topic of regulation and policy that we've been speaking about, definitely would be great to see more specific regulation targeting methane to create incentives, incentive mechanisms, and encourage innovation in the space so that companies and investors will have more reason and incentive to act.
Fantastic. Nusha?
Yes, me too. I would love to see more action. I would love to see also the Global Methane Pledge turn into Global Methane Agreement, which would then look post-2030. And I would also love to see more dairy and meat companies to move in the same direction as Danone and Upfield. Thank you. And thanks for hosting this, Peter.
Yeah, well, that's been my great pleasure. I mean, I think from a Planet Tracker perspective, as our report says, we think financial institutions have a huge role to play, are currently behind the curve, but will get big benefits from their own net zero perspective of really stepping up to the plate and starting to demand more information and more action around agri-methane. So, look, thank you everybody who's joined us on this webinar. We've had a fantastic audience. We've had a huge number of questions coming in. Very sorry we didn't have time to answer them all, but it just remains to me to say many thanks to Nusha and the Changing Markets team for collaborating with us on this report, and a big thank you to Jeanette and Sally and Tara for joining us on what has really been an absolutely fascinating webinar. Thank you very much indeed. And as I said at the beginning, the webinar has been recorded and will be available on all usual channels fairly soon. Thanks very much indeed. Take care.